Welcome to the Finance Wisdom Summaries. Here's a condensed summary of the key takeaways from Stocks for the Long Run by Jeremy J. Siegel. The book presents extensive historical data supporting long-term stock investing. It warns against the emotional difficulty of sticking to a long-term strategy, emphasizing emotional discipline. While history is a guide, market paradigms can shift. Stocks are the superior asset for building wealth over the long run, consistently outperforming other options despite short-term volatility. Market downturns, though painful short-term, are opportunities for long-term investors to buy at discounted prices. Unrealistically high investor expectations from recent strong returns are a potential short-term problem. Most important and impactful lessons. Emotional discipline is paramount. The historical evidence for long-term stock superiority is compelling, but human emotions, fear and greed, are powerful. Recognizing this inherent psychological challenge is crucial for success. Stocks for long-term wealth. Equities are the most reliable path to wealth building over decades, consistently preserving and growing purchasing power. Best practical example for daily application. Think of your long-term investment plan as a GPS. While temporary traffic, market downturns, might make you want to take an unproven shortcut, trusting the proven long-term route is key. When there's a sale on stocks, it's an opportunity to buy more quality assets at a lower price rather than panicking and selling. Chapter 1. Stock and Bond Returns since 1802. Even the Great Depression did not negate the superiority of stocks as long-term investments for patient investors. Equities consistently dominate all other assets over 2 centuries, with bear markets appearing as mere blips in the long-term trend. Stocks have shown remarkable stability in real after inflation returns, averaging 7.0% annually across major sub-periods. Unlike fixed income assets, stocks have consistently preserved and grown purchasing power over centuries, proving to be an excellent long-term inflation hedge. The equity risk premium has been high post-WW2, but appears to be returning to a lower historical norm. Key takeaways. The power of long-term compounding. Immense wealth creation is possible through consistent long-term investment in equities. Even significant crashes become minor events in multi-decade frameworks. Equities as inflation hedge. Stocks are superior to fixed income assets in preserving and growing purchasing power against inflation over long periods. Notes for daily application. For your long-term retirement savings, think of your investments as planting a tree. You wouldn't dig it up daily to check its roots. Similarly, trust the historical evidence that planting your money in diversified stocks and letting it compound over decades is the most reliable path to financial abundance. Chapter 2. Risk, Return, and the Coming Age Wave. Stocks are riskier than bonds or bills in the short run, but become less risky, in real terms, than bonds for holding periods of 10 years or more. For 20-year holding periods, stocks have never fallen behind inflation. The probability of stocks outperforming fixed income assets dramatically increases with longer holding periods, virtually 100% over 30 years. Attempting to time the market is incredibly difficult and often leads to inferior results compared to a buy and hold strategy. The age wave, baby boomers entering retirement, poses a demographic challenge, but a global solution involving capital flows from developing to developed economies is crucial. Key takeaways. Long-term investing reduces stock risk. Stocks become less risky than bonds in real terms as the holding period lengthens due to mean reversion of equity returns. Your true holding period is longer than you think. The relevant period for portfolio allocation is the entire duration you plan to hold any financial assets, often decades. Notes for daily application. If you're saving for your child's college education 15 years away, while bonds might feel safe in the short run, Holding diversified stocks has historically proven much safer for preserving and growing the real value of your savings over such a long horizon. Chapter 3. Perspectives on stocks as investments. Early views saw stocks as speculative, but Edgar Lawrence Smith's 1924 work, Common Stocks as Long-Term Investments, demonstrated their superiority over bonds in all price environments. The common stock theory was often misused to justify excessive speculation as seen before the 1929 crash. Later academic research consistently reconfirmed the significant long-term superiority of stocks over bonds, even with taxes and transaction costs. John Maynard Keynes lamented the lack of long-term investors, noting human nature's desire for quick results. Key takeaways: the paradigm shift in stock perception. Understanding the historical shift from stocks being seen as speculation to the best long-term investment reinforces confidence in long-term equity investing. Beware of "this time is different." Market euphoria often leads to the dangerous belief that this time is different, as exemplified by the 1920s mania. Notes for daily application. When you hear about a hot stock that can only go up, remember the historical warnings against believing a stock is worth any price due to perceived indefinite growth. Focus on diversified long-term holdings instead of speculative narratives. Chapter 4. Stocks, Stock Averages, and the Dow Strategy. The Dow Jones Industrial Average is price-weighted, meaning high-priced stocks have a greater impact regardless of company size. The inflation-corrected DJIA shows a long-term appreciation trend, but excludes dividends, which are a significant part of total return. The Dow 10 strategy, buying the 10 highest-yielding Dow stocks, has historically outperformed both the DJIA and S&P 500 with lower risk, attributed to value investing in survivor firms. However, widespread adoption of the Dow 10 strategy could erode its future advantage. Key takeaways: long-term trends versus short-term predictions. Don't let short-term signals distract from the fundamental upward trend of the market for patient investors. Popularity erodes alpha. Once an investment strategy becomes widely known and adopted, its historical outperformance tends to diminish. Notes for daily application. Instead of constantly checking stock market news for short-term explanations of daily movements, focus on the big picture. The Dow 10 strategy's success and its potential future erosion due to popularity is like a secret fishing spot. Once everyone knows about it, the fish become harder to catch. Chapter 5. Dividends, Earnings, and Investor Sentiment. The historical relationship where stock dividend yields exceeded bond yields ended in 1958 due to inflation, proving that benchmarks are valid only when economic institutions remain stable. Stock value is determined by the discounted future cash flows, dividends, and earnings. Long-term investing in stocks requires patience, not foresight in market sentiment. The earnings yield, reciprocal of PE ratio, is the best long-term guide to real stock returns. Contrarian strategies, buying when others are pessimistic, selling when others are optimistic, can be profitable because market movements often overshoot fundamentals due to investor psychology. Even if stock prices revert to historical PE norms, a decline benefits long-term investors who can accumulate shares at discounted prices. Key takeaways: fundamentals versus sentiment. While long-term stock value is rooted in a company's earnings, short-term movements are heavily influenced by unpredictable investor sentiment. Patient investors can ride out emotional waves. Contrarian thinking pays off. Markets tend to overreact, creating opportunities for those who buy when fear is high and sell when optimism is rampant. Notes for today's application. When financial news is overwhelmingly negative and everyone says sell, a contrarian investor looks to buy. Conversely, when the market is euphoric and everyone is giving stock tips, it's a sign to temper expectations. Chapter 6. Large Stocks, Small Stocks, Value stocks, growth stocks. Historically, small stocks have outperformed large stocks, but this outperformance is often concentrated in specific periods, such as 1975, 1983, and in January. Value stocks, low PE, low price per book, have generally outperformed growth stocks, particularly among smaller companies. The outperformance of value stocks, especially large ones, is also linked to the 1975-1983 period, and much of this outperformance occurs in January. IPOs generally underperform in the long run after their initial trading day. Diversifying across all market capitalizations and value growth styles is recommended, rather than trying to time style cycles. Key takeaways: the size and value anomalies. While historical data show small cap and value stocks outperforming, this outperformance is often period and month specific. Diversification across styles. Instead of chasing hot styles, a diversified portfolio across various market capitalizations and value growth characteristics is more robust. Note for daily application. When you hear about the next big thing IPO or a tiny tech company, remember that exciting narratives rarely guarantee long-term returns. Stick to broad diversification rather than chasing speculative stories. Chapter 7. The Nifty 50 Revisited. The Nifty 50 were premier growth stocks in the early 1970s with very high PE ratios, often believed to be overvalued. An equally weighted portfolio of the Nifty 50, bought at its peak, performed almost identically to the S&P 500 over the next 25 years, suggesting they were not wildly overvalued long-term. Many Nifty 50 stocks, despite high PE ratios, were undervalued based on their subsequent earnings growth. For example, Coca-Cola. The Nifty 50's higher earnings growth largely justified their higher PE ratios. However, picking individual growth stocks is risky. Diversification is crucial even among premier companies. Key takeaways. Growth can justify high prices, but risky. Exceptional, sustained growth companies can justify high PE ratios, but this is rare and difficult to predict for individual stocks. Diversification for growth investing. Even among top growth stocks, significant winners and losers exist. Broad diversification within growth segments is critical to manage risk. Note for daily application. When a popular tech stock trades at a very high PE ratio, resist the urge to dismiss it entirely, but also don't assume it's a sure thing. Diversify your investments to capture potential successes without the extreme individual stock risk. Chapter 8. Taxes and Stock Returns. Maximize total real return after taxes. Stocks have a tax advantage over bonds due to capital appreciation, which is taxed upon realization, often at lower rates. Deferring capital gains taxes significantly increases effective annual returns, as assets compound at pre-tax rates. For most investors, holding stocks in tax-deferred accounts, TDAs, is generally better than in taxable accounts. If a portfolio exceeds TDA limits, place high dividend value stocks in the TDA and low dividend growth stocks in taxable accounts to maximize tax deferral. Key takeaways. The power of tax deferral is a massive advantage for stock investors, allowing money to grow undisturbed by annual taxes for longer periods. Prioritize tax-deferred accounts for equities. Maximize contributions to TDAs and fill them primarily with stocks. Note for daily application. Prioritize putting your fastest-growing stock-based investments into tax-deferred accounts like a 401k or IRA so they can grow tax-free for decades, leading to a much larger sum in the end. Chapter 9. Global Investing. U.S. stocks now comprise less than half of the world's equity capitalization, making global diversification essential. The primary reason for investing in foreign stocks is diversification and risk reduction, as foreign markets do not move perfectly in tandem with the U.S. market. Economic growth alone does not guarantee superior stock market returns at a country level, as high expected growth is often already priced in. Hedging foreign exchange risks is often unnecessary for long-term investors, as equities themselves provide a hedge against currency depreciation due to inflation. Key takeaways. Global diversification is non-negotiable. Investing solely domestically significantly increases risk. Global diversification across regions and economies is crucial for reducing overall portfolio risk. Diversification, not chasing growth. Focus on the risk reduction benefits of diversification across global markets rather than speculating on high-growth economies. Note for daily application. Build a globally diversified portfolio that includes various flavors from around the world, US, European, Asian, emerging markets, to create a more robust and resilient financial diet, rather than only investing in your home country. Chapter 10. Money, Gold, and Central Banks. Monetary conditions exert an enormous influence on stock prices. Historical events like the abandonment of the gold standard led to stock market rallies because they allowed for credit expansion and liquidity. The quantity of money in circulation is paramount in determining the price level. Sustained inflation requires continuous money creation. Changes in the Fed funds rate have historically been a very good predictor of future stock prices. Increases lead to significantly lower returns, decreases lead to significantly higher returns. Monetary stringency, tightening, is painful for the stock market, while easing, liquidity, is welcomed by equities. Key takeaways. The central bank drives short-term markets. Central bank actions regarding interest rates and money supply are the single most important short to intermediate term influence on stock prices. Liquidity is king for equities. Stock markets thrive on liquidity provided by the central bank. Note for daily application. Think of the central bank as a gardener controlling the water supply to the plant, stock market. Ample water, monetary easing, helps the plant flourish, while restrictions, monetary tightening, cause it to wither. Paying attention to central bank signals is like observing the gardener's watering patterns. Chapter 11. Inflation and Stocks. Inflation significantly erodes the purchasing power of fixed monetary payments, making long-term bonds particularly vulnerable. Stocks are excellent long-term hedges against inflation, as their returns generally keep pace with it. However, stocks are poor short-term hedges against inflation, with real returns falling as inflation increases in the short run. The U.S. tax code exacerbates inflation's negative impact on stocks by taxing nominal profits, corporate and capital gains, rather than real profits. Despite these downsides, stocks are still the best financial asset in a rapidly inflating environment compared to bonds. Key takeaways. Stocks, long-term inflation shield, short-term vulnerability. Stocks protect against inflation over decades, but can struggle with it in the short term, especially due to tax distortions. Bonds are vulnerable to inflation. Fixed income assets cannot protect investors from inflation due to their fixed nominal payments. Note for daily application. For long-term financial goals, choose stocks over bonds because stocks are like real businesses that can adjust prices with inflation, protecting your purchasing power, while bonds are fixed loans that get eaten away by rising prices. Chapter 12. Stocks and the Business Cycle. The stock market often falls prior to recessions and rallies before economic recoveries, but is also prone to, quote, false alarms, declines not followed by recession. Official business cycle dating occurs well after the fact, making it useless for timing the market. Attempting to time the market based on economic activity is extremely difficult and likely to result in underperformance. The worst strategy is to follow prevailing sentiment, buying high, selling low. Key takeaways. The market as a flawed leading indicator. While the market anticipates economic shifts, its false alarms and the lag in official data make it unreliable for timing. Avoid emotional market timing. Resisting the urge to buy into optimism or sell into pessimism during economic cycles is crucial for long-term success. Note for daily application. Don't try to time the market by predicting every economic downturn or upturn.
Instead of constantly adjusting your portfolio based on economic news, stick to a long-term plan, much like you wouldn't move your house every time a weather forecast changes.
Chapter 13, World Events Which Impact Financial Markets. Most daily market movements are random and not attributable to specific economic or political news. The market fears uncertainty and reacts negatively to sudden, unexpected changes, often creating temporary buying opportunities. Historically, the stock market has performed better under Democratic administrations than Republican, and the third year of a presidential term has been best. Market volatility has generally been less during wartime than peacetime. Do not let politics or war dictate long-term strategy. Key takeaways. Randomness dominates short-term. Don't seek elaborate explanations for every daily market tick. Most are random. Uncertainty creates opportunity. Market overreactions to unexpected events often create temporary dips that can be good buying opportunities. Note for daily application. When major breaking news hits and the market reacts sharply, resist the urge to immediately sell or buy. Markets often overreact to uncertainty, and unless the news fundamentally changes long-term earnings, patience is key.
Chapter 14, Stocks, Bonds, and the Flow of Economic Data. Markets respond to the difference between announced data and market expectations, not just if news is good or bad. Stronger than expected economic growth tends to increase interest rates, which can have an ambiguous effect on stock prices, positive for earnings, negative for bond competition. Higher inflation generally harms both stock and bond markets. Fed easing, lower interest rates, is typically very positive for stocks. For most long-term investors, ignoring daily reactions to economic data is preferable. Key takeaways. Markets price in expectations. Prices move based on unexpected news, not just the news itself. Short-term noise. The constant flow of economic data is primarily relevant for very short-term traders. Long-term investors should ignore it. Note for daily application. Don't overreact to every economic report. The market has likely already anticipated much of the news. For long-term goals, focus on the overall trend of your portfolio rather than daily data surprises.
Chapter 15, Stock Index Futures, Options, and Spiders. While stock index futures offer high leverage and low transaction costs and often lead the underlying stock market movements, SPDRs, ETFs, allow ownership and a trust, matching indexes like the S&P 500, offering tight spreads and easy short selling. Both futures and SPDRs enable investors to hedge stock market risk. Options, puts and calls, offer limited liability for buyers, but are risky for inexperienced investors. Portfolio insurance strategies using futures contributed to the 1987 crash by amplifying selling pressure. Circuit breakers, trading halts, were implemented post-1987 to prevent rapid destabilizing price movements. The most important and impactful lessons. These tools efficiently manage risk and gain market exposure for large investors. Beware of leverage. High leverage and complex strategies carry significant risks, especially for inexperienced investors. The best practical example for daily application. For the average long-term investor, simple, diversified index funds are generally safer and more effective than trying to master complex futures or options for market timing.
Chapter 16, Market Volatility and the Stock Crash of October 1987. The 1987 crash, while severe, did not lead to an economic depression due to the central bank's swift action in providing liquidity, unlike the 29 strategies. Portfolio insurance strategies, relying on selling futures, amplified the crash by creating illiquidity. Volatility is inherent to stocks and necessary for above-average returns. Historical volatility peaked during the Great Depression. There is no overall upward trend in volatility over time. Market volatility often reflects investor overreaction to news and sentiment. Key takeaways. Central banks in crisis. Decisive central bank action can prevent stock market crashes from spiraling into economic catastrophes. Volatility is inherent. Accept market fluctuations as a given for long-term equity returns. Note for daily application. When the market experiences a severe downturn, remember that it's a storm. If the underlying economy and financial system are sound, thanks to central bank safeguards, your long-term portfolio can withstand it.
Chapter 17: Technical Analysis and Investing with the Trend. Technical analysis uses past price trends to forecast returns, in contrast to fundamental analysis. The random walk hypothesis suggests stock prices are unpredictable because all known information is already incorporated. Simulations of random stock prices look like real charts, challenging the idea that visible trends are predictable. While moving average strategies can reduce risk, the returns often vanish after accounting for transaction costs. Any successful method will eventually be nullified as more investors adopt it. Key takeaways: efficient markets versus apparent patterns. Stock prices are largely random, meaning patterns are often coincidental, and attempting to profit from them is difficult and costly. Costs of active trading. Transaction costs are a major hurdle for any active trading strategy, often eroding any potential gains. Note for daily application. Don't get caught up trying to time the market by reading charts. The costs and difficulty usually make it a losing game. Focus on long-term, diversified investing. Chapter 18: Calendar Anomalies. Calendar anomalies are predictable patterns in stock returns that challenge efficient markets. The January effect is significant. Small stocks historically outperform larger stocks in January, accounting for most of their long-term outperformance. September is historically the worst month for stocks globally, often showing negative returns. Other patterns include stronger returns in the first half of the month and around holidays, and negative returns on Mondays, known as the Monday effect. As anomalies become widely known, their effectiveness tends to diminish. Key takeaways: behavioral biases create patterns. Investor behavior can create statistically predictable patterns, but these tend to fade as they're exploited. Anomalies for timing, not core strategy. Use these patterns for optimizing already planned transactions rather than as the basis for your core investment strategy. Note for daily application. If you're already planning to buy or sell, knowing about patterns like the January effect might help you choose the best day, but don't base your entire financial plan on them. Chapter 19: Funds, Managers, and Beating the Market. 1. The vast majority of actively managed equity mutual funds underperform broad market benchmarks over long periods, primarily due to high fees and trading costs. 2. Index funds allow investors to match market performance at very low cost. 3. It is extremely difficult to identify truly skilled money managers versus those who succeed by luck. 4. High costs significantly hurt long-term wealth accumulation. Even a 1% annual fee can drastically reduce final wealth over decades. 5. The goal for most investors should be to match the market at low cost, not to beat it. 6. Financial advisors are valuable for providing emotional guidance to investors to stay the course and avoid self-defeating market timing. Key takeaways. 1. Inefficiency of active management. Most actively managed funds underperform due to costs. Passive indexing is superior for most investors. 2. Costs compound. Minimize fees as they significantly erode long-term wealth. 3. Note for daily application. Instead of hiring an expensive coach promising secret techniques, simply focus on running consistently and keeping equipment simple. Passive indexing. It often wins the long race. Chapter 20: Structuring a Portfolio for Long-Term Growth. Successful long-term investing is simple in principle, buy and hold diversified stocks, but difficult in practice due to emotions. Stocks should be the overwhelming proportion of long-term financial portfolios, with inflation-indexed bonds as a safe alternative. Invest core holdings in low-cost, highly diversified index funds, e.g. S&P 500. Allocate to mid and small-size stock funds up to 25% and international equities up to 25% for diversification. Maximize contributions to tax-deferred accounts and fund them with stocks, especially high-dividend stocks. Proper investment strategy is as much a psychological as an intellectual challenge. A good advisor can provide crucial emotional support. The core lesson is that owning stocks, diversified, long-term, is far more important than which specific stocks. Key takeaways. The blueprint for long-term success. Build a robust, diversified, low-cost portfolio emphasizing global equities for the long run, leveraging tax advantages. Psychological discipline is key. The greatest challenge is sticking to the plan through market volatility. A good advisor helps maintain focus. Note for daily application. When planning your finances, focus on broad diversification across global stocks in tax-advantaged accounts, committed for the long term, rather than agonizing over individual stock picks.
Book main idea. Stocks for the Long Run by Jeremy J. Siegel champions common stocks as the premier asset for enduring wealth creation, demonstrating their consistent outperformance over bonds, bills, and gold across 2 centuries. This superiority stems from their link to real economic growth and inflation hedging capabilities. While short-term volatility exists, long-term equity risk diminishes. The book advocates a disciplined, low-cost, diversified buy-and-hold strategy in global equities, emphasizing that emotional fortitude is paramount for investors to capture these proven long-term advantages, regardless of market noise or expert predictions.
If you enjoyed the content, please consider supporting the author. Thanks for watching, and if you like this video, subscribe. Now, let's go to the next video.